cut, I wanted to discuss investing during recession. And I know some of you are probably out there like, oh my God, he's going to talk about stocks. But recessions can actually be some of the biggest money-making opportunities. And a lot of people are going to be losing money, maybe even losing their jobs during this time. And if you don't make the cut right now, this may actually be your last opportunity. The way it looks, it could wipe out the middle class. Now, the reason I was so bearish on stocks was their excessive valuations. But things are changing. They're changing fast. We have a special phenomenon happening in our market right now. It's called panic. The time not to buy stocks is when they're at an all-time high. But panic can work wonders for you. That's when people are terrified and they begin to move all their money out. But I don't think every stock is a good pick. And they all haven't reached their bottom either. Some strong companies, they're going to return to business as usual someday. They're going to be much stronger. Others might even thrive. And when the tide goes out, you get to see who's swimming naked. That's what they say. And the strong companies, they still have the clothes on. And at the end of all of this, they might be much stronger, though they are temporarily priced below their value, substantially. Now, because of the state of the market, they're being driven down because the entire market is being driven down. And they're dealing with this in spite of the fact that they're actually moneymakers. But first, let's realize this may be a prolonged recession. It may be a little nastier. Even a controlled recovery steered by the Federal Reserve, which means certain winners would be picked out. Ray Dalio, for example, he runs the biggest hedge fund in the world. He basically has been saying we're already in a major depression right now, which is an extended period of economic decline. Now, some companies and sectors, they've been thought to be invincible. But we have a good glimpse right now through that lie because people are not buying the same kinds of companies. Have you taken a look at FANG recently? They're toothless, shopping at the Goodwill for dentures. But to be exact, you want to consider the companies who can actually thrive during inflation too. The ones that will be able to raise their prices and end up riding that wave up as it crashes over their competitors. The companies that don't produce actual things or any kind of profits or money, they're not going to be a good place to park your money right now. Think of Facebook or Big G or Netflix. A lot of the consumers, they're beginning to cut back on their spending, their excess spending. They might even cut out their Netflix. People are pulling back on ads sometimes. But I mention this because you can't discount companies like Amazon, for example. They're big enough to remain profitable, and they actually might increase their profits due to the inflation. They're going to have cash flow, and they're also going to have the economy doing well. They're going to be doing well too. So there's not going to be that big shock effect. A lot of companies like Walmart's or, the Costco's. Now, if you get some headlines suggesting that there's hope, some of the other companies might do worse because people think it's over. The bad news is over, and they pull their money out, very fast. But this is a fact that consumer confidence is down right now at a record low, and there's little hope out there right now, but a headline could suggest it. Businesses like Costco or Amazon, they might be cutting employees, but they're not going to fail. They might not even struggle right now. But there's also companies that may not be as affected by inflation as others. And Amazon practically sets the prices against companies that are never on sale. These companies never on sale. Another category you might want to look into would be small luxuries. If we end up turning into like a Mad Max hell, women are still going to continue to buy makeup. They might even buy more. Now, it was huge in the last depression. Coca-Cola, that grew during the last depression, another small luxury. But really, the proven recession-proof companies, when panic sets in and investors freak out, side note, the people who run Wall Street, they got 85% of that money when they freak out. But when they're panicked, they say, I'm out of the market. They sell everything, and that includes companies like Chipotle, for example. The interesting thing about Chipotle is they increased their cash flow and grew 20% a year right through the entire last recession. Unfortunately, a lot of people figured that out, so the stock has doubled since March. To find more recession-proof companies, just take a look back at 2008. See who did really good in terms of their actual revenue, not their stock performance, and you're going to find some winners. I know another smoking hot company right now that I found out about is Gold Royalty Corp. Even if you search the entire gold and silver industry, it's hard to even find a deal like this or a company that's been so aggressive, sometimes even doubling in size at once. From a lot of key institutional investors, they've already identified this company as being a winner. Regarding patience, it's just a matter of when right now that this industry is going to take off. Gold, and the entire industry for that matter, is a perfect example of a precious asset that has gone down because the entire market has gone down. I know one day, when we're standing above a $2,500 gold price, there's going to be a lot of people looking back, wishing they didn't ignore the fundamentals and what I consider basic common sense, in my opinion. We already know gold can help protect your money during times of crisis or inflation, You know that the gold eagles right now, they're flying off the shelves. You know, it shows consumers they're getting a little nervous. For the year, gold bullion demand is up a staggering 617%. When you factor in the related sales disruptions from last year, the bullion sales are up 400% over their 5-year average between 2015 and 2019. Bullion sales, they better reflect the anxiety that investors are feeling right now. When you hear economists talk about a recession, it starts to make sense why bullion sales are so strong. Gold will always be a long-term store of value. But what performs even better than gold, it happens to be the miners, the mining industry, but this is beyond miners. Gold royalty companies provide funding for miners. And we've had a special thing going on in the gold industry is a lack of exploration. And because of this lack of exploration, these companies now need to get to work. They need to get busy because when the demand picks up, they need to have gold. They need to have access to it, and the reserves are down across the world. Even some of the biggest mining companies, they have their reserves declining, and their grades declining. So they need to find more gold, and to do this, they need capital. And despite the fact that this industry has almost never been more capitalized right now, these balance sheets have never been more stable at a lot of these mining companies, they're still going to need more money, more capital to get in there and to dig. Where does that come from? It comes from royalty companies. Royalty companies, they give them this money, and they get a percentage or a royalty from their mine. That means that royalty companies do not have any exposure to a lot of the problems that can come along with things like inflation. Big factor at this moment. So when you talk about the rising price of fuels, all they need to pay, all this goes into the cost of mining. All that also goes into the cost of the metal itself if there wasn't so much manipulation. But it doesn't go into the cost or the price tag for the investors at royalty companies. Now, the interesting thing about Gold Royalty Corp, that's one of the people who helps bring you this show, we talk about the re-rating potential of this company. They already went through one. They had their investors get like 35% when the company was re-rated last time. And that was because of some acquisitions they made that expanded their portfolio. But a lot of people are unaware that they just expanded their portfolio greatly now. So they have 2 more acquisitions that could send the company for another re-rating. That's like free money right there. The company's suddenly revealed to be valued much higher than it is officially. And they expect this potentially could happen in Q4 if everything goes right. They've already made the acquisitions. They should be finalized very soon. And by the time Q4 rolls around, we may see a real surprise. A surprise for people who aren't paying attention, which is why I'm so glad that I know about them. I've learned about them. They've grown so rapidly, aggressively, you have to say, because at one point they even doubled almost overnight. I've been watching this earlier, and I'm going to show this to you so you can check it out.
And thank you for introducing me today. And look, I think we're at a really, really interesting point in the metal cycle right now. We've gone through a number of years where mining companies, both on the base and precious side, have been focusing on deleveraging, harvesting returns on their existing assets after having spent billions of dollars in investing in new mine capacity about 10 years ago. And that was quite a party, and there was quite a hangover. And obviously, investors demanded that they focus on deleveraging, returning capital to shareholders, increasing dividends. And the industry's never been in better shape financially. They have squeaky clean balance sheets, effectively net zero debt across the industry. But what's been lacking is investment in exploration and development in any meaningful way. And that's why we've seen a consistent downward trajectory in reserves on both the gold and base metal side for the last half a dozen years or so. So that's coming to roost now. The industry is going to have to, out of existential need, reinvest back into the ground to replace depleting reserves and production. And in that end of the cycle, when you're starting to invest in exploration and development, royalty companies play an extremely important role in the ecosystem to finance that development and exploration, particularly for the emerging producers, the explorers. And that's really a niche that we're trying to fit. And to achieve that, though, you have to have a low cost of capital. You have to have scale. You have to have liquidity. And there's been a proliferation of royalty companies that have come into the market anticipating the need to reinvest back in exploration and development in the coming years. But what they haven't achieved is scale. So what we've tried to do in the last 6 months, really, since we IPO'd in March and raised $90 million US on the NYSE, is to create that scale rapidly so that we are competitive for our partners in providing them capital on a cost-effective basis so they can invest back in exploration and development. So we raised $90 million US back in March. We quickly pivoted to M&A, and we acquired Ely Gold. And my new partners from Ely Gold are here with me today, Trey and Jerry. Welcome. And delighted to have Trey on the board and Jerry join our team, continue to do what he does very well in Nevada. And we doubled the size of the company overnight. We had a post-money valuation after the IPO of $200 million. We approached about $400 million on a post-Ely acquisition basis. We only just completed that acquisition a couple of weeks ago, closed it, and then quickly pivoted again in announcing the acquisition of Abitibi Royalties and Golden Valley Mine and Royalties, which has the flagship Canadian Malartic mine, a royalty on that, the largest gold mine in Canada within its portfolio. And that's the prize. As Gold Strike is to Franco-Nevada, this is our Gold Strike, Canadian Malartic. It's not only Canada's biggest producing gold mine with 10 years of reserves or 10 years of production history behind it, but very, very capable operators in Agnico and Yamana, and 30 to 40 years of mine life ahead of it, with significant upside potential underground as it pivots to its underground mining from open pit mining over the course of the next several years with a $1.7 billion investment. Together with Ely, together with Golden Valley, together with Abitibi, we now have a portfolio approaching 200 royalties. So we've gone from 0 royalties a year ago when we were a small private company with an idea to 200 royalties today. And we have a broad spectrum of royalties from early stage exploration to production, and I'll talk about those in a bit more detail later on. But again, that foundational asset, Canadian Malartic, the best companies in the mining space, in the royalty space, whether it's the Franco-Nevadas, the Wheaton Precious Metals, the Royal Golds, they all have that kind of foundational asset that Canadian Malartic represents. In addition to obviously having a broad portfolio across the value creation spectrum in the mining business. So we have multiple avenues of growth, organic growth. Certainly there's continued scope for M&A in the space, but we have lots of growth within this pro forma portfolio that we put together over the last 6 months since our IPO. We exit that merger with Abitibi and Golden Valley with a very strong balance sheet, nearly $50 million US in cash, no debt, an experienced management team, which I'll dig into a little bit later on. I talked about Trey and Jerry, but they're complementing a very strong team that we already had. And the potential for re-rate is immense here. On the back of the Ely transaction, our shareholders enjoyed a 35% re-rate in their stock price. We see the same potential re-rate opportunity as we integrate Golden Valley and Abitibi into the portfolio in the coming months as we hope to close that transaction in the middle of the fourth quarter. Very briefly on the transaction, we've tied up 65% of Golden Valley's shareholders. They've supported the arrangement, 38% of Golden Valley shareholders, 65% of Abitibi's. What that tells you is they buy into and subscribe to the re-rate thesis, the double bump. We've obviously offered them a decent premium up front, but they see the potential within this broader portfolio of seeing a significant increase in valuation of their flagship Canadian Malartic mine with the increased liquidity and the scale of our business on a combined basis. This just gives you an overview of the portfolio. America's focused exclusively. 191 royalties, 6 already producing, and you'll see in a moment we have significant upward trajectory in our cash flow projections over the next 5 years, 7 in development, which will be cash flowing over the next 3 to 5 years, and you can see a broad array of assets from early stage exploration through to feasibility study, which will be populating our pipeline, I would say, for decades to come. So we have growth already within this pro forma portfolio as a result of the 3 mergers that we expect to complete over the course of the next couple of months. And in some very good jurisdictions, which I'll touch on a little later on. Canadian Malartic, it's worth spending a bit of time on this. This is really, as I said, a foundational asset. It has the potential to move the needle for us, much as it created that foundation for Franco-Nevada, which is now obviously the category killer in the royalty space. This has that kind of potential given its long life, its geological prospectivity, and it brings me back home. This is where I started my career back in the 1990s, initially building the Troilus deposit up in Chibougamau, and then as CFO of Agnico for 12 years, building LaRonde, building Goldex and Lapa, all within tens of kilometers along the same Abitibi Greenstone geological district. They've been mining from an open pit for the last 10 years. Agnico and Yamana has as co-operators. Now they're investing at $1.7 billion to build an underground mine to exploit a much larger resource. There's 4.5 million ounces of gold reserve here. There's a potential of $6 to $8 million of additional resource, 6 to 8 million ounces, of additional resource, which will significantly prolong the mine life. And that underground potential, as it's opened up for operation, you open it up for exploration. And that's been the history in this district, this geological district. As you get that deeper infrastructure in place, you not only get infrastructure for operation, you also get drill setups for exploration. And if I look back at the flagship operation of Agnico today, LaRonde, which I was on the team that built that operation back in the 1990s, that started out as a small zinc deposit delineated from surface. We sunk a shaft, which ultimately went down to 2,200 meters below surface. They're now mining down to 3,000 meters. But as they started to get lower horizon drill platforms in place, that deposit ballooned in size. And that's been the history of this geological district. That underground access is so important, so vital to really delineate what you have, to really explore the upside potential geologically of what ultimately you can mine here. And so as Wenzel Hubachek, who was our VP of exploration back in the 1990s, used to say, you always get surprised when you get underground in these deposits in the Abitibi, and always in a positive way.
Now, some key factors to consider is that in 2022, gold has held up much better than things like Bitcoin and is far better than the big tech companies, which were deemed to be invincible, of course, like PayPal, Netflix, Nvidia, Meta, and others. They're down anywhere from 30 to 70% right now. So Gold Royalty Corp is a company founded by Admir Adnani, same as Uranium Energy Corp and Uranium Royalty Corp. I'm sure you might have heard of them by now, but these two companies, they were founded by the same man, and just like Gold Royalty Corp and Uranium Royalty Corp, they're essentially sisters. So everything that just happened with Uranium Royalty Corp can replicate itself with Gold Royalty Corp. If gold catches a bid to $2,000 and above, we could see some sparks. So Newmont and Goldcorp, they merged a couple of years ago in what was the largest corporate merger in the gold industry history, a $32 billion deal. The CEO of Goldcorp is the mastermind behind this deal. His name is David Garofalo. He's now the CEO of Gold Royalty Corp. One thing they talk about is their intellectual expansion and bringing in experts. How could you find a better person to do it than somebody so successful? So the founder of Goldcorp, as well as several other most successful gold stocks in existence, is Ian Tefler. He's also part of the management at Gold Royalty Corp. These two individuals have run the largest gold companies in the world. They're very successful. You know, you have to be extremely successful and talented to be picked to be the CEO of the largest gold company in the world. And now, both of these men are over there at Gold Royalty Corp, and David is the CEO. Essentially, gold royalty companies have the best business model in the world because they don't have the exposure to a lot of the damages that inflation can do or other shocks, that could come into play. Eric Sprott is a big shareholder who has an impeccable track record at finding triple-digit winners. He's a self-made billionaire. And anybody who thinks they know, they know so much about investing, they know so much about stocks. This guy isn't one of the guys who's been handed everything. He went out, studied, got to know these companies, picked them out, and they're winners. And his ideology is a winner. Of course he knows silver and gold are going to be winners. Now, a little details about Goldcorp. They were a gold production company headquartered in Vancouver. The company employed around 15,800 people worldwide, engaged in gold mining and related activities including exploration, extraction, processing, reclamation. Their operating assets included 4 mines in Canada, 2 mines in Mexico, and 4 in Central and South America. As of the third quarter of 2014, Goldcorp was the 4th largest producer of gold. On January 14, 2019, Goldcorp agreed to merger an acquisition with Newmont Mining Corporation, the world's 2nd largest producer of gold, with the merger of Newmont Goldcorp to be the world's largest producer. Some of the key people at this company listed on Wikipedia, of course, are Ian Tefler and David Garofalo, who was the president and CEO at the time of this acquisition. In 2004, Wheaton River emerged with established Goldcorp Inc. in a $2.4 billion share swap that saw Goldcorp observing the Wheaton River. Following the merger, Goldcorp's board of directors, they appointed Tefler as Goldcorp's new chief executive officer. In 2006, he led the Goldcorp's friendly acquisition of Glamis Gold, a merger that at the time created the world's 3rd largest gold mining company. The new larger company retained the Goldcorp name, and the merger shifted Tefler from chief executive officer of Goldcorp to the company's chairman. Besides leading Goldcorp, he's known for founding and leading other Canadian mining companies, including TVX Gold, Silver Wheaton Corp, Uranium One, as well as some of his efforts to include donations to the University of Ottawa School of Management for $25 million, and now the Tefler School of Management. In 2013, he was listed in Canadian business magazine's The Power 50. He was awarded Ernst & Young's 2007 Western Canada Entrepreneur of the Year. In 2015, he was inducted into the Canadian Mining Hall of Fame. In the same year, he was awarded an honorary doctorate by the University of Ottawa. And he often speaks on lessons he has learned during his career, and he emphasized the importance of taking advantage of an opportunity when it presents itself. He has served as a chairman of the World Gold Council from 2009 to 2013. And now, both of these men are in the management at Gold Royalty Corp. Like I said, they're like a champion getting ready to run the race. Now, you guys already know my love for precious metals, my faith in precious metals, and also my belief that it may be one of the things that can help protect you from what is to come. But when it comes to royalty companies, they may be even better because they're less exposed to some of the dangers. And when it comes time for this industry to grow, they're going to be looking for real winners. And of course, this company has a lot of potential, like real potential, not just a fluffed up or inflated kind of ideals. This is a good company with strong backing, a strong balance sheet. And you can find more about this company if you want to learn more at just goldroyalty.com, their website. They have a little newsletter on there. And also, it's on the New York Stock Exchange under GROY and GROY.WS. Go over to their website, check out their presentation, see what they have to offer. Of course, they're one of the reasons why we're here. I thank you guys for stopping by and joining us. As always, stay free.